following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Brought to you by Zecco. Zecco is quite possibly the best value in online investing, offering a fully featured stock and options trading experience, spectacular customer service, and tons of free tools at pricing that is 30 to 50% less than the big guys. Keep in mind, options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options. For more information, including special offers, options education, and disclosures, visit Zecco.com/bootcamp. Now, let's start getting you into peak options trading shape. Here are your Options Bootcamp trainers, Mark Longo and Dan Passarelli.
All right, welcome back to Options Bootcamp. My name is Mark Longo from the optionsinsider.com, as well as the old Options Insider Radio Network. And I am joined today on the Options Bootcamp drill team by my fellow drill instructor, good old Dan Passarelli, the man, the major domo over there at Market Taker Mentoring. Dan, welcome back to the show, sir.
Yes, always good to be back, Mark.
I don't know if drill team perhaps conjures up the right connotation. People can think of a bunch of mini-skirted cheerleaders bouncing around on the field. So
That's
perhaps
actually what I was thinking of.
Perhaps I mixed my metaphors, so we'll leave the listeners with those two conflicting images in their head. And now Dan and I are also joined by a third member of our sexy drill team for this show today. He is Joe Burgoyne. He's a director over at the Options Industry Council. Joe, welcome to the show.
Howdy, Mark. Good to be with you, and hello, Dan.
Hey, Joe.
And Joe, since this is your first time on the old radio network here, why don't you give our listeners a quick overview of your background in the options space, and then give our listeners a quick overview of the OIC and what it is that you guys do.
Sure, Mark. Well, and it's nice to be with you. I got to say, I like your lead-in music. That's good stuff. Go
big or go home, as they say. We like to have a nice production value here for the old listener.
Oh, very good. Sounds good. Quickly, about me, I'm a Philly guy. I spent 20-plus years as a option specialist and market maker on the PhilX. Did a few other things besides that, but that's basically where I spent the majority of my career. And the last 3 years, I've had the good fortune to, be part of the OIC, the Options Industry Council. And as both of you know, we are a educational entity, cooperative, sponsored by the Options Clearing Corporation and the 9 U.S. option exchanges. And our entire mission is to get out there and, just like the two of you, teach investors about the responsible use of options.
Well, education is the name of the game here on the old Options Bootcamp. And so you are definitely the right man to have on the show today, sir. And with that, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, and welcome to Basic Training. This is, of course, a portion of the show where we break down you raw options recruits and help to rebuild you into seasoned options veterans. And today's topic for the old basic training section is buying options. Now, we touched on episode 1, the basic overview of options, what's a call, what's a put, all that fun stuff. And we touched on buying options a little bit in that segment. And then we dove into the Greeks for episode 2. And now with episode 3, we're going to bring it back a bit and discuss in some more detail different aspects of buying options and why you may want to do that and some of the strategies you can actually implement when you do buy options. So let's start off with the basics again. There are several reasons that you may want to actually come in and buy some options for your portfolio. First off, as we discussed in episode 1, there is that leverage aspect to options. So let's say you have a finite amount of capital in your trading account and you look at a particular stock and say, well, if I want to buy 100 shares of this stock, it's going to cost me $10,000. But perhaps if I look into the options, I can buy an approximate or somewhat equivalent position in the options for a much smaller outlay that will still give me that particular exposure to the underlying that I'm after, whether it's bullish or bearish or whatever the case may be. So leverage is usually what brings the typical retail customer into options for the first time. And then as they become a little bit more experienced in options, they begin to appreciate the hedging aspects, the defensive aspects of options. I mean, that is where you already have, let's say, a position in XYZ underlying, and you can come in and buy a put option, for example, and use that to lock in a floor at which you can guarantee yourself that you can sell that stock at any time. So that's the defensive aspect of options. And those are the two primary reasons that novice retail traders first get into the options market. Dan, would you concur with that?
Yeah, it really is. There's kind of like you were touching on, there's a lot of things that people really find attractive about options. And really, you don't have to pick just one. You get all those features, leverage and safety and all that goes along with it, all wrapped into one.
Now, Joe, when you're out there doing your road shows and interacting with that basic retail customer, what are some of the reasons they're giving you when they're saying they want to get into options for the first time? What is kind of drawing them into the fold, so to speak?
I think, what I hear most often now, Mark, is income generation. So that's not the buy side of options, but really the sell side.
That's episode 4, sir.
That's what I hear most frequently. But I also hear risk management, and certainly on the risk management side, more often than not, that is all about the buy side. And I'd say, third. And when we talk about buying options, there can be that speculative aspect coupled with, the leverage component you mentioned. So most often it's those 3 different issues.
I like the concept that people are coming to you guys looking for income generation. That means you guys are really attracting probably a second tier of retail customer versus the basic options customer who's kind of just coming in and learning the ropes because they've already learned enough to know about income generation. And we'll certainly get into that next episode. So that'll be a tease for our listeners. But today, as we said, we're talking about buying options. Now, when you buy options, it's not all sunshine and lollipops. There are some downsides as well. Of course, we touched on them a little bit in the past couple episodes, but the first and most important thing you need to consider when you're buying options is what we discussed on previous episodes, that time decay, aka theta effect. Of course, when you're buying options, you have to keep in mind that options die a little bit every day. They lose a little bit of their value each day that you approach their expiration date. So if you're buying options, you obviously need to account for that decay because your position needs to offset that decay in some way, shape, or form, whether it's through underlying movement or perhaps volatility movement for the more sophisticated of our listeners in order to offset that decay that you encounter every day. So that definitely is the number one thing that listeners have to keep in mind when you're buying options is you have to think of some way to overcome that decay. And the flip side of that, of course, is that because options have an expiration date, you have a very small window of opportunity for your position to actually perform and for your estimate of underlying movement or volatility movement to be correct. It's not like going out and buying a stock and you can hold it for an infinite amount of time. And if the stock moves against you, you just put it in your portfolio as a long-term hold. Options don't work that way. Options, you have to be right within a set amount of time or your position will expire worthless. So those are the two things you definitely need to keep in mind when you're buying options. Now, we touched on Greeks last week, and Dan is obviously the man with the plan when it comes to Greeks. For the novice options trader who's looking into buying options and tentatively getting into those waters, Dan, I would typically say that delta and theta would be the two Greeks that they really need to be most cognizant of. Of course, down the road, you need to learn about vol and what that vol impact does. But when you're first buying a contract for the first time, delta and theta definitely should be your primary considerations. Would you agree?
Yeah, and I'd say kind of in that order. Really, I would go as far as saying you absolutely need all three, but hey, if you're brand new to options and you don't have the Greeks totally under your belt just yet, start with delta, then move on to theta, and then don't forget about the importance of vega. I mean, that's where even retail traders can get a lot of edge on their trade by buying options only when they're cheap in terms of implied volatility and consequently selling them when they're expensive. So, if you're just kind of getting started in the Greeks, there's the path to go down: delta, then theta, then vega.
And Dan, we obviously just did a quick overview of theta. Why don't you do the same for delta then, since you are literally the man who wrote the book on Greeks. Why don't you give us a quick overview of delta, ATM, delta, all that fun stuff, so our listeners know what we're talking about here.
Yeah, sure, Mark. When you're buying options, it seems kind of intuitive. Hey, if I think the market's going higher, I'm going to buy a call because calls are supposed to gain value when the stock goes up. They lose value when the stock goes down. But the question is, how much do they make or lose as the underlying change? If the stock goes up 75 cents, how much do I actually make on my call? If the stock goes down $2, how much do I lose on my call? You have to know this. If you don't, you're just kind of guessing. You're just kind of winging it. And you're not going to be successful in the long run. So here's specifically what delta tells you. Delta is the rate of change of an option's value given a change in the underlying stock. Now, Mark touched on the moneyness, the at the monies, in the monies, out of the monies. The deltas are all different depending on the moneyness of an option. Options that are in the money have bigger deltas. They move more in step with the underlying stock. Stock goes up by X, the call's going to go up by pretty close to X if the call's in the money. Conversely, if an option is out of the money, the deltas can be very small. They'll still change in value with the underlying stock, but not a lot. Stock could go up by $2, and if you own a call that's really far out of the money, you might only make 20, 30, 40 cents or something like that. So you really have to pay very, very close attention to deltas because that's what helps you manage your expectations for potential profit or potential loss.
Now, Joe, Dan and I have weighed in on this a couple of times now. I'm curious what your opinion is. What we were just discussing there with the Greeks, you obviously do a lot of retail education. Do you even touch on vega in your earliest seminars? Or you save that for probably a more intermediate course?
We generally will save it for intermediate, Mark, but honestly, when I'm giving a basic presentation, I do throw it out there without emphasizing, without spending too much time on it. But I like to get it out there because I think it's really important for all investors, beginning, intermediate, or advanced, that they don't get intimidated by the Greeks. I mean, Dan just, walked us through the whole idea of delta in a very, simplified fashion. And, that's how the Greeks should be expressed. They're really not that complicated. And I think most importantly, investors just should not be intimidated by the whole concept of Greeks. To get back to your question, I will, just kind of mention vega, in my basic presentations. And, as we get further into it, I emphasize it a great deal because vega is, I think, the most important Greek.
Yes, it definitely is, and Dan and I both share that view, but we tend to do exactly what you do. We don't want to overwhelm the intro audience with their first taste of options being vague. You throw it out there, give them at least an overview of it, but you save a little more, I think, for the intermediate classes to come.
You were mentioning, we're talking of buying of options, and so it is so important for investors to understand that issue of theta, which I guess you're going to get into a little bit more. But it's really important to be able to manage that expectation around both delta and theta.
All right, and let's dive into some examples then of exactly what we're talking about. And the most common introductory options trade for most newcomers to the business is, of course, buying that first call option. So we're going to walk you through an example of buying a call on everyone's favorite underlying good old XYZ stock. And luckily, Dan and I have brought in the expert, good old Joe Burgoyne from the OIC, to walk us through that proverbial buying the XYZ call example. So Joe, take it away, sir.
All right, how about if XYZ today is trading at $50, guys, and we decide XYZ is going up? Not sure when, but we think it's going up. So we have decided we're going to buy a call. And we've decided to buy the at-the-money call. Dan touched on this a little earlier. Rather than an in-the-money call that has both intrinsic and time value, we'll buy the at-the-money call. With the stock at 50, that means we're going to buy the $50 call. So it's, all of the price of that call is time premium. So let's say we buy that call for $3, and our expectation is that the stock's going to go, up a couple points. So with the stock at 50, if we buy that 50 call and the stock goes up $1 to 51, we can kind of assume that the value of the $3 call is going to increase by about 50 cents because the options that are right there at the money have a delta of about 50. So that call should appreciate from $3 to $3.50 with the stock going from 50 to 51. Take it one step further, if we go from 51 to 52, with the stock at 51, that $50 call is now $1 in the money. So it's going to have a little bit greater delta than 50. Let's say it's going to have a 55 delta. So if the stock goes from 51 to 52, when the stock gets to 52, assuming it happens rather quickly and we don't have, a week or so of time decay, we can expect that $3.50 call to go to $4.05. So that's with the stock moving from 50 to 52. So that's one example, Mark.
That is like we said, the introductory trade du jour that everyone seems to start off with. They come into options, they learn about options and how they work and how they can use them to approximate bullish and bearish positions in the underlying, and surely enough, most people dive in with that long call. And so, as Joe mentioned, you need to be cognizant of your deltas. Of course, you have that at-the-money delta of approximately 50, the in-the-money delta of greater than 50, somewhere between 50 and 100, and the out-of-the-money delta somewhere between south of 50, somewhere between 50 and 0. So when you're looking to pick up your liquidity, keep that delta, of course, in mind so you know exactly how your options will perform, or at least how they're supposed to perform as the underlying moves. We'll get into some of the ways that that may change in a second, but that's the traditional bullish example. If you have a bullish outlook on XYZ underlying and you want to take a bullish stance using options, that buying of a call is your basic way to do that. Now, there also is a defensive, a protective use for buying options, and that is, of course, buying the put option to give yourself that guaranteed selling floor for your stock. Of course, if you buy a put, that gives you the right to sell the stock at the strike price of that option anytime during that option's lifespan. So you can see how buying a put in conjunction with owning a stock position could defend that stock position against a severe move to the downside. And I know, Dan, you're the put buyer among us here, so why don't you walk us through an example of a good old XYZ defensive or protective put?
Sure. That's one of the great things about options is that they are a veritable insurance policy if you want them to be. If you own a stock, you can protect it by going in there and buying a put. Now, Here's the problem with that. Puts ain't cheap. There are plenty of times where buying a put can cost you, somewhere around 5% of the value of a stock. If you go in there and buy a put to protect a stock position in the traditional sense, the way, sometimes you're taught in some of the more basic classes, if you make a habit of doing that, you're going to be a loser in the long run. And it's because puts are, like I said, relatively so expensive to buying the stock. But here's the solution to that. You don't just go in and buy a put month after month after month and hold it because, like I said, that's a loser in the long run. You have to kind of pick your spots. There are plenty of stocks out there, and I guess I can spare everyone of naming the first 10 or 20 that come to mind, but where you watch pretty closely and you see they kind of go up and down with the market, and if they have a string of up days, sooner or later they're going to have a down day, and you start thinking to yourself, well, now would probably be a good time to buy a put. Or there's some news expected, and you think, well, geez, now might be a pretty good time to buy a put. But what happens after you get that down day? What happens after the expected volatility event passes and you don't need those puts anymore? What do? You sell it. So let me kind of move past the prelude here and go straight to the example. Say XYZ these days is trading at $50 a share. Well, we could go in and buy the May 50 puts, therefore guaranteeing that no matter what happens, we can sell the stock at $50 a share. Even if XYZ stock drops to 20, we still own the right to sell it at 50. And of course, we'll pay for that. Maybe we'll pay $2.50, 5%. If XYZ stock does indeed fall a little bit, our puts are going to gain in value. How much? Well, they're going to gain in value by the amount of the delta. So you'll lose on the shares of stock. You'll gain on the delta of the puts. And so what can you do then? You can sell the puts, take your profit on those, and that offsets some of the losses that you endured in the stock. You don't have to hold them all the way until expiration.
That's a good point to hit on again. People come into options for the first time. They think they have to buy these things and hold them all the way to expiration, because that's, of course, what it says on the P&L expiration graph. You have to hold them to expiration. When in reality, the vast majority of options are sold well before they expire. So definitely a good point, Dan. You buy that put for protection. It's important to take advantage of that protection. When you have a massive down move in the underlying, time to take that protection off the table, perhaps roll to a different strike, but get some bang for that buck. Don't let the underlying then bounce back up, and then essentially your hedge has done nothing. A hedge is only a hedge if you actually use it. So that's something definitely the newcomers to options looking to buy protective puts have to keep in mind. All right, and now that we've hit on some basic examples of buying a call to speculate on the upside of a stock and buying a put to protect against downside movements with a stock, let's dive into some very common mistakes that novice first-time options traders make when they're buying options. And one of the most common mistakes that I'm sure Dan and you, Joe, see when you're talking to these newcoming traders or these novice traders for the first time is that they come to options looking to take advantage of that leverage to speculate on a particular underlying, and then they see exactly how much options cost. And you're right. Whether it's a put, Dan, or whether it's a immediate call option, options aren't cheap. Even though they give you that leverage aspect, they still can be relatively expensive. And so when newcomers see that, they then make the mistake of saying, well, these in the money and these at the money options are relatively expensive. I'm going to move all the way up the strike chain when they're buying, let's say, a call option, or down the strike chain when they're buying a put option, to these really, really, really far out of the money options because they're so cheap. And then now they're so cheap, I can buy 10 of these instead of one. And so they end up loading up on worthless, what we used to call on the floor, lottery ticket options, because they have about the exact same probability of paying off as a lottery ticket. And then, of course, those options expire worthless and they become disenchanted with the options business and they leave and never try options again. So that is the number one mistake newcomers who are buying options tend to make, is that they look at the options chain and they go right for the cheapest. And that, of course, neglects a lot of fundamental aspects of options that we've discussed on this program, including, like we just discussed, the delta. If you're buying a far out of the money option, you're not getting very much delta in that option. You're not getting very much bang for that buck. You're having a delta of 50 or less, and typically in some of these far out of the money ones, 30 or even 20 or less. So Delta also being the approximate probability that your option will expire in the money. You're buying an option with a probability of expiring in the money that is substantially less than a coin flip. If you went to the casino and did that, it would not exactly be a long-term viable betting strategy. And the same is true in options. It's not exactly a long-term viable, profitable strategy to migrate all of your trading and all of your liquidity into those out-of-the-money strikes. Now, Joe and Dan, I'm sure you guys see a lot of that as well.
Yeah, the biggest problem really is that, well, I guess there's two problems. People learn what the strategies are, but they don't learn how to use them. They form an opinion on direction, maybe a bullish opinion, maybe a bearish opinion. We'll just use bullish for this example. Oh, I read the chart. Oh, it looks like the stock's going higher. I should buy a call. The books tell me I think the stock's going higher. Calls make money when the stock goes higher. Done. Okay, I don't have to think anymore about it. But you do. Not only do you have to look at delta to get expectations as to, hey, how much is this going to help me if it goes my way? How much is it going to hurt me if it goes against me? But how long should I be holding on to this trade? Every day that I hold this trade, I'm paying rent on it. I have theta. And so you need to look at the theta on every trade. And we talked about this a little bit earlier, you needing to look at that vega, because if I'm buying a call, am I buying the call cheap or expensive? It's pretty tricky with options to tell if an option is cheap or expensive. And the only way you can do that is by using an option's implied volatility. And by looking at an option's vega, that's what tells you how the option will be affected by changes in implied volatility. So, you really have to not oversimplify, even with the simplest strategies. You have to look at the entire holistic picture and all the factors that are affecting the value of the option.
A couple things come to mind. One, oftentimes I hear, investors are out there, buying an option because they read a market newsletter and somebody said, go buy XYZ. And that may work some of the time, but from my perspective, investors really need to take the time to do their homework personally and not just follow recommendations that are put out there, in various news services. That's one thing. The other thing that I hear frequently, especially when I'm speaking to new investors, well, I've got to continue to study. I've got to learn everything there's to know about options. Not discounting education, of course, because that's the business we're all in. But at some point, investors need to put their toe in the water and buy an option. I guarantee that over the course of the next week or two, and I'm not saying, put a lot of money, into that option per se, but get into the marketplace, see how, your emotions react to actually being in the marketplace with an option. You learn about the Greeks, you learn about the delta, the theta real quick, much quicker by being in the game as opposed to theoretically being in the game. So they're just a couple ideas that I would offer, Mark.
Yes, exactly. And of course, you can do that buying the proverbial one option that you want to trade at your brokerage account, or even maybe starting off with the paper trading, which is also a good way to at least cut your teeth first so you're not learning on your own dime. Learn on the broker's dime. They have infinite amount of paper money for you to play around with, and then you can dive into the actual stuff once you have an understanding of how these concepts work. And speaking of concepts, I suppose we should dive into very quickly, since we are talking about buying options, that common component of options that a lot of newcomers misunderstand, which is, of course, intrinsic value, an intrinsic value of an option versus extrinsic value. Let's talk about that proverbial example that Joe was just giving, or just Dan, the old XYZ stock trading 50. If you look at, let's say, the XYZ 45 call, that call gives you the right to buy XYZ underlying at the price of $45. So if you look in the market and say, wow, XYZ is actually trading $50, that call obviously has $5 worth of value. That is what we call intrinsic value. That is the meat, quote unquote, of the option. That is what is the inherent value of that option by looking in the marketplace and seeing where the underlying is actually trading. Now, of course, if you go in to buy that option, you're not going to pay exactly $5. You're actually going to pay a little more, because there are these other aspects to an options price that we tend to lump together as extrinsic value. And these are all the things we've discussed previously on the show. The volatility premium, the interest, and a lot of the other factors that are placed on top of that intrinsic value in order to make the total options price. So when you're buying an option, you need to be aware of how much of that price you're paying is quote unquote meat or quote unquote intrinsic value. That's the value that's not going to go away from a decay perspective. If XYZ stock stays at 50 the entire time and you own that 45 call, that call will always have an intrinsic value of $5. It is the extrinsic stuff, the extra, the volatility premium, the time premium, these things that will decay to zero over time. Another reason why buying an out-of-the-money option is dangerous is because you're buying an option that is 100% extrinsic value. So it is extremely susceptible to the vagaries of time decay, and that entire position could decay to zero. Whereas if you bought an option and spent a little more on an option with some intrinsic value, some meat, as it were, you at least know that from a time decay perspective, that portion of the option is going nowhere. The underlying moves against you, of course, that price could change, but the intrinsic value of that option is not going to decay. And that's a mistake a lot of newcomers make when they come to the options market, is they don't understand the differences between extrinsic and intrinsic value, and they don't trade accordingly. And maybe last, we can round it up here with a quick overview of this, because it's hard to touch on this without getting into exactly what you said, Dan, which is Vega. But next to loading up out-of-the-money options, the other extremely prevalent mistake that newcomers make in the options market when they're buying options for the first time is they will load up on options right ahead of an earnings announcement. And this is a bad practice, usually, not always, but usually for a number of reasons. And since I've been talking for a while, I'll let you, Dan, or you, Joe, jump in with why the novice options trader should probably avoid loading up on premium going into an earnings announcement.
I'll tell you what, if I had a nickel for every time somebody came to me with a sob story about, hey, you know what? I bought calls right before earnings and the stock went up and I still lost money. What the heck's going on here? I'll tell you what, I would have a lot of nickels.
You and me both, sir.
Yeah. So here's the thing. Remember, I kind of made the analogy to options being like insurance policies. Well, they really are in many, many ways. And one of the ways is how they're priced. You know, when you buy an insurance policy, that they study your history, the statistics that lead up to having to pay out on your policy. If it's an auto policy, they look at your driving record. If you crashed 13 cars in the last 6 months, you're going to pay a ton for your insurance. Well, that's how it works with options too. When there's a big move expected, like, for example, on an earnings date, when, that's the time of the year when the biggest moves typically happen, that's when options start getting really expensive, because that's when all the hedgers go in and buy those puts for protection. Or that's when all the speculators go in there and buy calls or buy puts for speculation. The price gets really expensive right before earnings. So what does that mean? A lot of times, that's the absolute worst time to be buying options, because you're paying for the most expensive insurance, or speculation for that matter, that you can buy. So you got to be careful. You've got to look at the implied volatility, and you've got to basically make sure that the options haven't priced themselves out of reach for you, and make sure that you're not doing something, kind of silly and paying too much for the option. So always use implied volatility in conjunction, of course, with the options Vega. And, you just kind of keep listening to some of our back episodes and some of our future episodes. And all this is going to start making a lot more sense to you if you're, even if you are brand new to options.
I was just going to say, I think that's exactly right. Oftentimes, for new investors, it's not so much that, the things we're talking about are necessarily complicated, but it does take usually a number of times to hear it and sink in. So listening to previous, recordings as well as, future ones over, a couple times over a period of a month can really be beneficial and, can allow investors to really absorb all the education that you're offering. Mark?
Yes, the analogy I like to use for that example, and yes, you're right, Dan, that is still the number one question we still receive 5 years after launching the Options Insider is, I bought a call before earnings, the stock went up, and I lost money. Why did that happen? It's still by far the number one question we receive, which is amazing. I thought we answered that question 5 years ago, but apparently it still pops up every now and then. And, this is after saying we're not going to discuss volatility, so I'll keep it brief. But the analogy I like to use for these is that options and options prices are kind of like a balloon, and they sometimes inflate, particularly going into an earnings event like an announcement. That balloon tends to inflate dramatically to the point where you're paying an extremely inflated price from a volatility perspective, from an extrinsic value perspective for that option. So you have a price there where the underlying has to move a incredible amount in order for that option to break even. And then what you have happening is that all of that balloon inflation comes from the volatility buildup, the uncertainty going into the earnings announcement. Once the event has happened, whether it's good or bad, the uncertainty is pretty much over. And unless the event is dramatically different than predicted, that balloon is going to rapidly deflate. So then you have a scenario where you overpaid and you paid for all of this extra helium you didn't need, and it's going to rapidly come out of the balloon. And so then you have to have the underlying move a significant amount after earnings for any of those super inflated options to pay off. And so that's just one example. We can get into down the road as we do more advanced examples too of options volatility skew and why those upside calls sometimes tend not to perform as expected. But that is indeed for another show. But right now, I think that's going to wrap up our overview of buying options and some of the pros and cons and some of the strategies you may want to implement when doing so. So, Joe, before we go, first off, thank you for joining us here on the show today. We're always happy to have you guys from the OIC on the show with us.
Fun to be with you guys for sure.
And then before we go, can you give our listeners a taste, if you will, a brief plug of what they can find over on your website, optionseducation.org, and also if you have any upcoming events that our listeners might want to know about, then by all means, feel free to let us know, sir.
Okay, real quick, Mark. When you mentioned the website, as it turns out, last week of March, we used to have 3 websites, and that was the retail website, the institutional website, and the financial advisor website, and we morphed them all into one. So all of our resources, 20 years of material, are all now under the one address, www.optionseducation.org. We've got webinars, podcasts, all kinds of online education. If you are just getting started, we have something called My Path Education. Basically, you fill out 20 questions, and it'll tell you whether you're a beginner, intermediate, or advanced. And with that response, you will have different lessons downloaded to you based on your level. So things like that, as you mentioned earlier, Mark, we've got a trading simulator, pretty much anything you need with regards to options education, you can find at our site. And the great thing is everything is funded by the options industry, so there's no charge for any of it. The other thing we do offer for people who like to actually speak to somebody, we have our help desk out in Chicago and down in Dallas, Texas, and you can reach our investor services desk at 188-OPTIONS. And lastly, just real quick, I guess we do have a couple events coming up. This Friday, we will be taking 13 industry experts to the Rutgers School of Business in Newark, New Jersey, for one of our Road to Wall Street Analyze Your Options days. So we'll be reaching out to the college community this Friday. A week from Saturday, we'll actually have a retail all-day event in downtown Manhattan at the Grand Hyatt on 42nd Street. That'll be one of our investor education days. They're wonderful, again, paid for by the industry, late breakfast, full lunch, and wonderful speakers from 9 in the morning till 4 in the afternoon. So you got to get a lot of sleep the night before to be able to make it through that full day, but really a great day. And then I guess lastly, and I think I'll be joining Dan in Dallas in early June at one of the Trader Expo events. So there are a couple of things we've got coming up.
I think there might be a steak dinner involved there, Joe.
I sure hope so. And maybe even a cocktail or two.
All right. With that lovely image of the two of you imbibing and having large quantities of red meat, we're going to close out. We're going to close out this basic training segment and roll right into our roll call segment.
Roll call! You boots listen up while today's guest speakers are announced.
All right, and welcome to the roll call segment. This is where Dan and I welcome some poor, unsuspecting victim from the world of options. And today's guest/victim is none other than Benny Joseph. He is the product manager over there at Zecco. Benny, welcome to the program.
Hey, thanks, guys. Thanks for having me on the show.
Yeah, we're glad to have you on because we're really eager to dive into the world of mobile. You know, mobile really has become, for many options customers these days, mobile is where it's at. Mobile is where the game changer is when they're choosing a brokerage firm. And we see this all the time at the Options Insider. You know, the number of questions we've received, it used to be years ago, is which broker had better commissions on X, or which broker maybe had tools for this, but a significant percentage of those questions coming in now are which broker has the best mobile app for this or the best mobile app for that. And it's really a driving factor for a lot of them these days because, quite frankly, you know, let's face it, most customers these days are not going to have time to sit in front of 3 trading screens at their desk all day. They're out and about doing their jobs. And when they're doing that, or perhaps they're commuting, and when they're doing that, they still want to have access to the full functionality of their broker. So that mobile app is increasingly becoming the face of the broker for a lot of customers. Would you agree there, Benny?
Yeah, definitely. We've heard that loud and clear from our customers, and that's why we decided to really take it a step further with our Zecco mobile launches this year.
You know, a lot of the people coming to the mobile world, they expect a brokerage app to be able to handle stock trades, and that's pretty much the bare minimum. So we're not even going to focus on that because our audience really is primarily concerned with options. So let's get the basics out of the way then. I'm assuming, and I hope you can confirm for me, I'm assuming that you can execute options trades on the Zecco mobile app. Is that correct?
Yeah, for sure. You know, one of our primary goals of Zecco Mobile was to give customers the ability to trade options on the go. And as long as you're approved for options trading, you can trade options much the same way that you can trade them on our website in the Zecco Trading Center.
Well, that's always a good start if you can offer the same functionality as the website, or at least an approximate version of it. Now, speaking of functionality, one of the things we discussed extensively on the last program here of Options Bootcamp, Dan and I really ran the gamut of the Greeks the whole way through, and we've received a lot of feedback on that episode and on the Greeks in general. And so I'm assuming one of the things our listeners are going to want to know, and hopefully you can address for them, is can you access, let's say, the Greeks of your position via the mobile app?
Certainly. Much like the website, we know that our customers demand this type of data. We do show the Greeks, delta, gamma, theta, vega, rho. We also show other data points that are useful for option traders, such as open interest, volume, open, high, low, and close. You know, one of the real challenges we had was coming up with the design without cluttering the interface. You know, as you know, with a mobile device, you don't have much screen space.
Yeah, your real estate is relatively limited.
Yeah, exactly. So what we did is we took a modified option chain that's very similar to the one that we use to Zecco Trading, and we customized that to work with the mobile devices. And what that allows is it allows our customers to have a consistent user experience no matter what platform they're using of ours. And one of the nice features we have is by simply, you know, tapping on the headers of the option chain, you can cycle through all these data points that are of interest to you.
Now, Dan, just as an aside, how crazy is that? You know, we've discussed on previous shows just how far the tools have come and what is available for your average, or in this case, the audience of this show, the very basic retail customer, and what is available to them essentially for free. And the notion that you can pull up your Greeks now on your smartphone on the go. That's just, I mean, for a guy who was trading with sheets on the floor not that long ago, that's just crazy to me still in this day and age.
It really is. It's incredible. Yeah, you're right. I mean, for you listeners out there, I mean, you guys probably don't realize it was really just a few years back where we would have our clerks go and run pages after pages of matrices and matrices of numbers, you know, instead of just being able to pull up the value, boom, right there on your computer. Holy cow. We'd pay, you know, a couple $1,000 a month for the software, pay the clerk, have them run these sheets out. I mean, it was It was nothing like it is now.
It was a significant expense and an undertaking, and the notion that and you needed a lot of computer power to run that analysis, and took a while to do. And now the notion that you could just push that out to a smartphone is crazy, just absolutely crazy in this day and age. You kids, you whippersnappers out there, don't know what value you're getting these days from a tools perspective. Speaking of that value concept, Benny, and speaking of the functionality that you were discussing earlier with trying to apply the same level of functionality to the mobile app that you bring to the website. Obviously the target audience for this show is the introductory, the novice options trader. The goal is to take those options raw recruits, as it were, and transform them into seasoned options veterans. But we still have some sophisticated listeners out there. And also the goal obviously is to bring all these newcomers into the fold, so to speak, and make them experience. And the thing that many experienced options traders are really concerned with when it comes to mobile functionality or website or what have you are complex multi-leg spread orders. So if I'm Joe, sophisticated retail options trader, can I come in and trade a multi-leg spread on the Zecco mobile app?
You certainly can. I think that's one of the ways we kind of differentiate ourselves from the rest of the competition out there. You can trade all of the predefined option strategies that are currently available in the Zecco Trading Center, as long as you're approved for those option strategies. And these strategies include covered calls, spreads, butterflies, iron condors. And again, if you're approved for them, you'll be able to trade them in the mobile app.
That's great. So as long as you have that level of approval, whatever level it is, then you can trade the appropriate strategy. That's a fantastic thing to have available on the go. But let's break it down here to brass tacks, Benny. Let's say I'm listening to this show and I am in the process of choosing my options brokerage firm. And for me, the deciding factor is going to come down to their mobile functionality. Obviously, there's a lot of mobile apps out there, a lot of brokerage apps out there. So let's break it down for that listener who's on the fence right now. You're the guy who made it, so you're the best person to break it down for them. What features do you think really set the Zecco mobile app apart from the rest of the pack out there that you can find in the iTunes store?
Right. Well, I think the first one we just talked about is the ability to place complex options. But more than that, it's being able to do that in a simple way. We really focused on making the app simple, intuitive, and fast. And that meant not only adding features such as options trading, but also making the decisions not to include features that would complicate the experience. With every feature that we added to the app, we asked ourselves kind of two questions. One, is this simple and intuitive? And two, is it fast? And if we ever said no to one of these questions, we went back to the drawing board. So let's take an options trading, for example. Trading options can be a little bit complex, and we didn't want to further complicate this by making order entry difficult. So one of the things we did was solve this pain point by making it easy to, for example, closing your positions from your portfolio. So let's say, for example, that you have XYZ butterfly in your portfolio, and you wanted to close that position. By simply swiping that position on your portfolio, it immediately populates a closing order in your order entry ticket. It's
That's
that
fantastic.
simple.
It's great.
Yeah. And that means, in as little as one swipe and 2 taps, your order is in the market.
I love that you've appropriated the iOS swipe functionality and you've co-opted it for your own purposes. I like that. That's good.
Yeah. Finally, what we wanted to really focus on is making the app fast. We use some very complex programming techniques to make the app as fast as it is. That means your option change loads fast, you place orders, and it's fast. And really, we had a threshold that we wanted to hit with app speed, and I think we did that.
Well, that obviously is very important too, that you can actually populate the ticket obviously very quickly. That's a UI function, and also execute very quickly and get the trade through and very quickly. Those are all very, very important features here for the listener out there who's on the fence and who's evaluating the different mobile apps. That's definitely something I think you want to keep in mind when you're looking at the various offerings out there in the different app stores. Now, we're running a little long here, Benny, but before we go for the old roll call segment, we're very interested here on the show in listener feedback, audience feedback. We engage with our audience on a regular basis, and I'm sure you guys do the same thing over there on the Zecco app team. You want to see what kind of ratings you're getting in the various stores and what some of their favorite features are, what your customers are saying. So is there anything out there you're seeing in those various comments that's interesting for our audience? You think, are the bulk of the customers, what are they saying their favorite feature is? And is there anything you plan to do to act on that feedback going forward?
Right. Yeah, no, based on, the reviews that you can see in both the App Store and Google Play, I think it's pretty clear that Zecco Mobile for both iPhone and Android has been very well received by our customers. Currently, both the iPhone and Android have been rated 4.5 stars from our customers, which is pretty good. And I have yet to see any of our competitors that have both an iPhone and Android app to be rated 4.5 stars or above. And customers are saying that they really like the app and that they are using it frequently. And we recognize that, this world is, we're moving to a post-PC world. And we believe mobile is an important channel for us now and will be even more important in the future. Zecco Mobile is an offering where we can accommodate our customers' needs that need an investing solution on the go. And customers have suggested some improvements, and we're definitely acting on them. Over the next few months, we'll be launching an update for both Zecco Mobile for Android and iPhone that addresses some of these problems, and in effect is going to take the usability of our app to kind of the next level.
Well, I'm glad to hear that, and I'm sure our listeners are glad to hear that. And it sounds like you've appropriated a term from good old Steve Jobs with the post-PC era. It sounds like Zecco is definitely embracing that mantra and taking it to the next level. Well, thank you for that, Benny, and we'll have to bring you back on again down the road where we can discuss some additional features that you guys are implementing in the mobile app and how our listeners can take advantage of them.
Thanks a lot, guys. Thanks for having me on the show.
Great. Thank you.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to this inaugural mail call segment. Of course, here on Options Bootcamp, it's not just about me and Dan and our collective guests gassing on at length. No, we like to hear from you guys as well. And we have a few questions coming in from the Zecco community on their Facebook page. And we're going to kick things off with a question from Arsalan. And he writes, if I buy a call option and when it is time to exercise it, will that be done automatically, in parentheses, from the strike price or by the cost basis price, which would be the premium plus the strike, parentheses, or will I need to do something? And what if I don't have the buying power to exercise the option? What happens? Can I just have it buy, he means his broker, can I just have the broker buy and sell the stock right then and there and just have the profit? Thanks. Well, Arsalan, this is a pretty straightforward one. First off, when you buy the option at that strike price, let's say we're talking about the call option on XYZ stock that we were alluding to in the basic training segment, you will buy it on a specific strike price. In the case of our example, XYZ was trading at 50, you bought the 50 strike call. That gives you the right to buy XYZ stock for the price of 50 anytime during the life of that option. So you're not going to be exercised and then get the stock at the strike price plus the premium. That doesn't happen. You get the stock at the strike price of your option. The premium is what you pay for it, and that's what you have to figure out in terms of the trading, how to overcome that premium that you paid in order to make the trade profitable. But it's automatically exercised for you at that strike price. So let's talk about that process for a second, the automatic exercise process. The Options Clearing Corp sets what they call automatic exercise thresholds. And it used to be back in the day when Dan and I were on the floor, it used to be relatively wide. It was a nickel or more in most options, where that means you had to be within a nickel or so of your strike price in order, or a nickel past, I should say, your strike price. So in that case, in the XYZ 50 call case, would have to have been XYZ stock would have had to have been $50.05 or greater, and your call would have been automatically exercised. They've since dramatically reduced that threshold down to a penny. So if the underlying is even a penny in your favor, meaning if it's even a penny past the strike price in your favor, then you will be automatically exercised. There is nothing that you have to do to make that happen. The only time you have to do something to make your exercise happen is when you want to exercise in a non-traditional environment. Let's say you want to capture a dividend or something like that with a call. Then you have to actually manually contact your broker and go through their manual exercise process. But 9 times out of 10, or 99 times out of 100, I should say, you don't really have to do anything in order for the option to be exercised. If it's even a penny in your favor, then your contract will be automatically exercised. And you need to also take that into account when you're trading, because as your second part of your question implies, you need to have the buying power in your account in order to buy that stock if the option is in your favor. If you don't, then you probably want to do what Dan and I always say, which is close out your positions going into expiration. There's no reason to keep that position all the way through expiration if you don't have the money in your account and you have no desire to take delivery of that underlying. You can just sell that option out, close it out, and not have to deal with the consequences. And as to your specific question, what if you don't have the buying power to exercise the option? Most brokerage firms will give you a little bit of float. They'll exercise the option automatically and then give you, I believe it's 3 days now, Dan, is that correct, in order to put the capital in your account?
I'm not sure what the cutoff is, but 3 days wouldn't surprise me. Sounds about right.
It's somewhere between 2 and 3 days. So some savvy options traders will actually game that. They'll allow the position to be exercised and take advantage of essentially 3 free days of the underlying exposure. Of course, that's also a risk. The stock could go down in the 3 days that you have the position too. So you don't need to instantly have the money in your account, but you should wire it in within a couple of days. And that process is going to vary depending on your broker. If you have questions, by all means, contact your broker and ask them exactly when you need to have that money in. Usually it's within 3 days. Otherwise, they will then automatically sell and liquidate that underlying position. So there you go. Automatic exercise thresholds of a penny, and you don't need to do anything if you want to take the underlying. It will just be automatically exercised for you. And if you don't have the money, then you better get it. Otherwise, at least enough to cover the 50% margin on the equities. Otherwise, you will be forced to liquidate that underlying position. Anything to add there, Dan?
Yeah, no, just you got to pay pretty close attention around expiration. Chances are, if you're watching this show, you're either an active trader and you trade options not as a proxy for the underlying stock, but you're trading the options. You probably don't have the intent of getting assigned or exercising. So close it down before expiration. That's what I tell all my students. Just get out of it. Move on to the next trade before then. Expiration day is a day with unneeded risk. Close it.
Our next Facebook question comes from someone with the obscure handle of Mike. And he writes, this is one for you, Dan, so I'll let you run with this one. Is delta a measure of how much the option moves in relation to the stock? Example, a delta of 0.7 would mean if the stock moves 10%, then the option would move 7%. And since, Dan, you're Mr. Greek, I will let you run with this one, sir.
Sure. Look at delta simply as the percent the option moves relative to a change in the underlying stock. And the easiest way to visualize this is if the stock moves by $1, my option will move by whatever percentage of $1 that is represented by delta. So for example, if my delta is 35, if the stock goes up by $1, my call will go up by 35 cents. That's 35% of $1. Now, I like to just use $1 movement in these examples because it's very simple. It's very easy to calculate 35% of $1. It's 35 cents. But keep in mind that if the stock moves $1.57 or something like that, some number other than a simple dollar, all you got to do is take that delta, in this example 35, and multiply it out times whatever the move is in the underlying, and that will tell you the option price move that is a result of stock price movement based on delta.
Yeah, I tend to do the same thing. I think most traders were trained to think in dollar increments. Mike's example here of 0.7 with a 10% move is a little bit obtuse. It's a hard way for a novice person to come to this and understand what he's talking about. But think of everything in dollar increments, and it makes a lot more sense. So a 0.7 in this case of $1 move would be move 70 cents, and that's exactly what delta means. Okay, thank you for that, Mike, and of course, Arsalan. And that is going to do it for our mail call segment. That's also going to do it for this episode of Options Bootcamp. I, of course, want to thank our guest, Joe Burgoyne from the Options Industry Council, and encourage you to go check out optionseducation.org to learn more about what the boys at OIC are up to. Of course, want to thank our other guest, Benny Joseph, the product manager over at Zecco, for illuminating us on all the different things going on in the mobile app for Zecco. And of course, last but not least, I want to thank you, one Dan Passarelli, for joining me on the show yet again. I'm discouraged you didn't invite me to your Texas steak barbecue, but c'est la vie. I'll wipe the tears away, and we'll proceed with the rest of the show.
You know what? I can bring you home some leftovers.
There we go. There we go. A nice doggy bag from Texas. I'll take that instead. But Dan, why don't you let our listeners know what you have coming up and what's going on in Market Taker Land that they might want to check out?
Yeah, we've got a whole bunch going on. Well, as Joe mentioned, I'm going to be in Dallas in June. I've actually got a class there that is, $295 for a full 4-hour class. It's going to be really, really fantastic. I've got some information on my website, or of course you can email me always at dan@markettaker.com. And every month I do a 4-part online education series. This coming month in May of 2011 is Mastering Time Spreads. If you're watching this recorded and it's after May, that's okay. You can still sign up because I keep the recordings for 6 months, and you'll get to see that one along with a whole bunch more classes. So we've got that going as well. So thank you, listeners, for joining Mark and myself. I hope you got a lot out of this. And if you ever have questions, feel free to email me, dan@markettaker.com.
Of course, we want to encourage you, too, if you want to follow in the footsteps of good old Arsalan or Mike, then surf on over to the Zecco Facebook page and post your questions for Dan and myself there. We'll be happy to answer them on further shows. You can also go into the Zecco Pulse community and ask your questions there. And if you want to learn more about what's going on in Zecco, then surf on over to zecco.com/bootcamp. You can listen to all the episodes of this show and learn a lot more about what Zecco has going on from an options perspective. So by all means, head on over to zecco.com/bootcamp. And last but certainly not least, if you want to hear more about any of the topics we discussed on this show or any of the other programs we have going on the old Options Insider Radio Network, then by all means, surf on over to www.theoptionsinsider.com. You'll find everything we discussed on the show today and much, much more. So Dan and I want to thank all of you for tuning in and making this show such a screaming success. We're rocketing up the iTunes charts. So thanks again for listening, and we'll see you next time right here on Options Bootcamp.
This episode of Options Bootcamp was brought to you by Zecco, quite possibly the best value in stock and options trading. If you'd like to submit a question for the hosts, visit facebook.com/Zecco and post it on the Zecco fan page. Zecco reminds you that options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options at zecco.com/ODD. Multiple leg option strategies involve additional risks and multiple commissions and may result in complex tax treatments. Please refer to the spread trading disclosure found in the options agreement and disclosure document at zecco.com/disclosures. The Greeks represent the consensus of the marketplace as to how the option will react to changes in certain variables associated with the pricing of an option contract. There is no guarantee that these forecasts will be correct. Technical and other supporting data on this program can be supplied upon request by contacting editor@zecco.com. Electronic trading has inherent risks due to system response and access times that vary due to market conditions, system performance, and other factors. Options Bootcamp is produced by the Options Insider Incorporated in association with Zecco Holdings Incorporated. preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.